The S&P 500 was up 20% last year, and this year is expected to be great as well. However, earnings came out on some of the big bank stocks last week, and their prices took a dive. And we all know the prices with stocks move up and down. However, what do you think most people do when the prices take a hit? They panic and sell and get out of the market and lock in the losses. Aren't we supposed to buy low and then sell high and lock in profits? I'm not sure why people always like to do the opposite. In this video, I'm going to answer the questions: why did some of the big bank stocks get hit last week following earnings? Why is now the right time to stay long the market and buy LEAPS options in SoFi, or hold on to them prior to earnings if you already have them? And I'm going to show you exactly how to buy a SoFi LEAPS option on the option trading platform. Hey guys, Darren here. We've got a great video for you here today. However, first, if you appreciate the time and effort that goes into making these videos, if you'll do me a favor and hit the like and subscribe button to help get the video out to more people, I'd really appreciate it. It helps out the channel tremendously, so thank you very much. I think it's super important that we understand all the different strategies that the rich are using to get richer. Then we can use those same strategies to profit for ourselves in any market safely. Be sure and download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. Why did the big bank stocks get hit last week following earnings? I'm going to quickly touch on a couple that I own, Bank of America and Wells Fargo, and one that I don't right now, JP Morgan. Bazinga wrote an article covering the disappointing news around the big bank stocks' earnings and how one-time charges melted their income. Bank of America had a couple of charges related to replenishing a fund for bank failures and how it indexed some trades. The interest rate headwinds were only partially offset by strong organic growth and good cost management. Net interest income fell 5%. And that's the heart of the bank's business. The stock price dropped 1% to $32.80, so well below the one-year target on Yahoo Finance. Notice, Bank of America also pays almost a 3% dividend as well, and a lot of the bigger institutions own Bank of America. It was already low on the year, which is why it probably didn't drop too much. My longer-term target for Bank of America is $40 per share, so I still think it is a great buy right here. Wells Fargo reported $1.29 earnings per share and $30.55 billion revenue, so they beat both top and bottom line. However, it also guided that its net interest income is dropping from 9% to 7% for 2024. For the fourth quarter, Wells reported a higher provision for credit losses of $1.28 billion. Wells' performance is sensitive to interest rates and the health of the economy. And now it looks like the Fed may wait to cut until later in the year, and maybe only 2 or 3 times as opposed to 5 or 6. Wells dropped 3.34% on the day down to $47.40. Yahoo's one-year target is $55, and mine is about the same. JP Morgan Chase beat expectations on both the top and bottom lines. JP Morgan was the only bank to report a rise in net interest income, and it was 19%. And they forecasted a record $24 billion in net interest income. However, even with their good beat, they were also down 0.73% at the close on Friday after earnings. They even indicated a strong 2024 and that the economy is looking very resilient. So with the big bank stocks being hit and being down, what do you think happened with SoFi's stock price? Yep, it got hit too. It dropped almost 3.5% to $7.89. And I own 14 LEAPS options contracts. So do I think SoFi's going to zero and I should sell? Heck no. SoFi has earnings coming up soon in a couple of weeks on January 29th. This is the first quarter that SoFi is expected to possibly be profitable. So why is now the right time to stay long the market and buy Leaps options or hold on to your stock in SoFi? The analysts that come out and rate the banks love to group SoFi right in with the big banks. However, there really is a difference with a digital shift that is occurring, and SoFi is different than these other banks. They have 0 brick and mortar branches, so the cost savings for that alone is outstanding. The younger generation loves the digital shift. They should turn a nice profit because of the cost savings and the digital-friendly mobile app. They're a one-stop shop for banking, lending, and investing. If you want to really dig in deep and understand the SoFi business, I did a video covering it that I'll link to below, so be sure and watch that one. It really outlines the differences between SoFi and the big banks. So how do you buy a SoFi Leaps option on the option trading platform? You're using the tastytrade option trading platform. You can do this on any option trading platform or brokerage. However, tastytrade is one of the best and most intuitive for trading options. These are the guys that developed the TOS Thinkorswim option trading platform and then sold it to TD Ameritrade. TD and Schwab use the platform to this day. tastytrade is even better. Use the link below and you can get cash back when you open an account. I do recommend that you open with around $5,000 so you can place a few different trades. We punch in SoFi in the upper left on the trade page to pull up the option chains. We are going to click on the January 2026 option chain and open it up since it's 733 days to expiration. I like to go at least 1 year out and closer to 2 years if the price difference is not that much. The stock price is currently trading at $7.89. So we will buy the 3-strike deep in the money call option by clicking on the ask. The cost is $5.70. Since one option contract controls 100 shares of stock, this is really $570. However, keep in mind, if you were to buy 100 shares of stock outright, the cost would be the stock price, the $7.89, times 100 shares, or $789. So it's quite a bit less to control the same number of shares. Switching to the curve mode, we can see that as the stock price increases, we profit just as if we own the shares outright. We hit review and send and place the trade. Looking at the 1-year chart on TradingView, you can see that SoFi was just up above $11 per share in July, and I suspect it will be right back and even above there soon. Remember, SoFi has earnings later this month on January 29th, and that is where we will likely see the stock move. I suspect it will be good news. They may indicate that they are profitable for the first time now in Q4, or if they're not, they likely will indicate that they expect to be profitable the following quarter, this quarter in Q1. Either way, that will likely be considered good news and could be a catalyst for the stock price to jump up higher. However, you never know with SoFi, and it is a volatile stock. That is why I like to stay small using the Leaps options, and they're 2 years out, so we have time to wait, and I do believe it's just a matter of time before SoFi really explodes up. And I firmly believe they will at some point this year. All right, guys, if you're a beginner and this sounded kind of confusing, don't worry. It did for me as well at first. We'll continue to learn together and succeed in future videos. Also, be sure and download that free options workshop. Remember to hit like and subscribe. Leave me a comment. Let me know. Remember, SoFi earnings is coming January 29th. Are you trading the earnings? Let me know what you're doing in SoFi. Thanks for watching. See you in the next one.